Can you guys see the screen I'm sharing now?
Yes, yes.
Where I'm showing the 2015, 2016, 2017, 2018, 2019.
You got this from Fin24, right?
Yeah.
Okay.
Great. So, guys, here's the last 10 minutes. I want it to be a discussion. I want to be a discussion for you guys to, to give your thoughts, your analysis. What do you guys think from what I've discussed so far and the result that you're seeing now?
Okay, their cash has been increasing over the past 5 years, which is good, and their current assets has also been increasing. We just can't see their debt levels, their liabilities. So we don't know on the other side how they are doing.
It's liabilities.
They have been consistent with their liabilities. Their debt books are looking good. It's like they're not increasing their liabilities. It's like it's constant, which is good because they're increasing their current assets and their assets value. They're increasing, but their liabilities, their denominator is just decreasing. So, which is
okay,
net asset value for the company.
Okay, which is quite interesting, which means the total liabilities are almost the same, but
it's the same.
Their total assets are drastically increasing. Now, what does that label reinvested capital mean? This company is actually reinvesting most of their money back into the business.
Yeah, that is good.
Which is good. So it also means that let's look at their liquidity. Tell me, what do you think about the liquidity?
Okay, their immediate debt, they can be able to pay all their current assets with their current liabilities with their current assets. So their current ratio is looking good.
Bro, are you sure?
Let's go up.
Yeah, I'm there.
What is that? Yeah, the total current asset is at 8.4 billion. Isn't that so?
Yeah.
Yes, and their total current liabilities is at 2.17 billion.
Yeah.
So their current asset ratio isn't current ratio the current.
So this is let's look in 2019 in particular. This is like the total current assets.
Yes.
And this is the total current liabilities.
Yes.
And it's doing well. It's looking fantastic.
Yeah, they have good cash in order to through this period. I just don't know for how long, but their balance sheet looks healthy.
Yeah, their balance sheet looks very strong. They've got a very high liquidity. And I want to go and look into their current assets. What is making their current assets very high?
Okay, there's two significant things. The cash and their inventory, which is the stock that they have, right?
Yes.
Yeah, so that the inventory is a tough one because we don't know how quickly they can empty that stock.
Okay.
Yeah, so if I was to, I would disregard that value, but even if I'm disregarding that value or discounting it, they still have enough cash to pay off their immediate debt and other things.
Yeah, so the company still have enough money to pay off all their what do you call it? Even if we can just talk cash only, they can still able to run the business at a high, very good liquid ratio, right? I want to get these other guys on the platform. We have to give. Can
D. I don't know if the other guys can hear us. But Mulife is saying that liabilities are consistent. So he's basically agreeing with what we were talking about.
Okay. You think that liabilities are consistent. But if you look at so which means they are not increasing like their liabilities, they are maintaining it a very good ratio. So which means, okay,
So
when I
there's
look,
another opinion from Lebo Khang.
yeah,
It says it looks very strong. They're not too exposed inventory. I think it's because of the household income. Customers are not buying a lot of products. So that's why their inventory is a bit significant and it has been increasing over the years.
or the inventory.
Yes.
Okay, so but inventory to some extent, remember they're also including the amount of shoes and trousers in the shop.
Yes.
So to some extent, they have to keep their inventory projected to the demand.
Oh,
You
okay.
see, yeah. So over the years, you can see their revenue has been increasing. So which means the demand is increasing. So which means their inventory has to also increase. You see,
All right.
that's why for this particular case, I don't think inventory, if you're testing liquidity, inventory is not a good term to include in there.
It's not a good term to include, right?
Yeah, we can just remove it, and usually you can just look at receivables plus total cash and other current assets which are there. But these are the main two ones. But still, even if we exclude inventory, they are still in a position to pay back the expenses.
So with the receivables, is it like the guys that have Mr. Price card and they took clothes using that card? What is
Which card?
the receivables? Like I go and purchase clothes without having cash so that I can pay on monthly installments, credit cards.
Yeah. It's partially that credit cards, because if you look at let me show you something here. If you look at the right, I wanted to check at their data accounts, 1.4 million.
Okay,
Did you see that?
okay, yeah, it's not a lot, yeah.
No,
How much?
data accounts. Data accounts, these are individual accounts, not the money.
Oh,
So
1.4
you
million accounts that are
account,
okay. I thought that was the money.
you see. So which means each and everyone here can have average of 100 rands. It's a lot.
Yeah, it is a lot. It is a lot.
Yeah.
Oh, it's
Yeah.
basically mostly the credit cards.
Yeah, mostly the credit cards. And you see, um, as you can see here, that Mr. Price has been having they sold units sold 220 million, the number of units that they sold last time. And yeah, I think those are the only relevant things here. The rest is just playing games with us. So,
So, what
uh,
likelihoods of the receivables defaulting, people not being able to pay, and all of that? Is it a value that we can discount or we take it as it is?
um, we can discount it because there might be some bad debts, right?
Okay.
But remember how these retailers actually do. They resell their debt
All right.
to other companies,
Or to other
to debt
companies.
collectors. Yes.
Okay. Your projection is no longer visible.
Is it visible now?
No.
Okay. You mean, what do you mean my project? Is it visible now?
Your shared screen.
It's no longer visible.
Yes, you're no longer sharing the screen.
Okay, let me check. Am I sharing now?
Yes, you are live.
Yeah. So this is what you can see. There's also check. So we said that their liquidity is good. We agreed on that they've got good liquidity, and we agreed that this business, you can see that their total retained earnings. You see now, you see their retained earnings has been increasing.
Wow. That is the money that they brought back to the company.
This is the man that they brought back the company. But my question is, so these are the retained earnings, which is been increasing steadily over the years.
Mr. Price is organic growth, ne?
It's mainly organic growth, Mr. Price.
Because I think their goodwill is very low.
Yeah, their goodwill is very low. It's mainly organic growth. So this is an accumulative retained earnings, right? Yeah, I think this is an accumulative. This is an accumulative retained earnings. So you see, they are creating some good value, Mr. Price. So yeah, so this is their balance sheet. Let's go to their cash flow and see how their cash flow looks like.